Hello everyone, and welcome to the Worth and Wealth seminars. My name is Jennifer Duran, and I'm a program associate here at the Office of Economic Empowerment. And today's topic is credit confidence, build a strong financial future. So it's all going to be about credit and credit scores, and credit worthiness. And before we get started, I'll jump into a brief disclosure. A reminder that today's webinar is being recorded, and feel free to find more details on that in the chat. Also, a reminder that all the materials, including the slides and some supporting documents and resources, will be sent out via email by the end of this week. And lastly, when you exit out of today's webinar, you'll see a pop-up feedback survey come up. Feel free, it has 5 quick questions, and let us know what you thought about today's webinar, today's topic, and what you want to see in the future. Okay, now without further ado, I'll introduce our presenter for today, Emily Gutierrez. Emily is a risk analytics senior manager at Citizens Bank. She works on the credit reserving team, focusing on retail portfolio. But I will let Emily introduce and speak more about herself. Thank you for joining us, Emily.
Thank you so much for having me. Like Jennifer said, I have been at the bank, Citizens Bank, for 6 years now. I work in the credit team, and I started in a risk rotational program. So I tried a couple different areas of risk, and then I landed in um, on the reserving team. So we take every single loan in the bank and we set a reserve on it, in case there was someone stopped paying on their mortgage, something like that. We have money set aside to cover off on that risk. So that's what my team does. Also, this is a personal fun thing. I actually interned at the Office of Economic Empowerment back in like 6 years back when I was in college. So that was a good time. Really happy to help support them and their mission. All right, so I think I'm good to start sharing my screen and jump right into our presentation.
Yes, thank you.
At any point, feel free to put a question in the chat, and uh, I might be able to see it, but if not, I'm going to have Jennifer kind of monitor that for me. Okay, let me know when you can see it, the window.
Yes, we can see it.
Thank you. Okay. So welcome, everyone. So we're going to be talking about credit confidence today, and just why don't we do a moment and in the chat, maybe we can say a couple of things that come to mind when we hear the term credit.
Okay, in the chat, couple of things that come to mind when we hear the word credit.
I can always say some too. So for me, I think of my student loans, if I ever wanted to buy a house, a mortgage, things like that, um, as well as credit cards and FICO scores. Those are what come to mind for me.
Yes, we have similar things here. Credit score, credit cards come to mind.
Nice.
Debt, home equity loan,
Oh, good
I have
ones.
here. My
All
personal
right.
one, complicated.
Yeah. Okay, so today we're going to cover kind of credit scores. So it was a good one to call out, including how to access credit reports, improve scores, and protect credit. All right, moving on. So to level set, we have 4 objectives for today. The first is to understand credit reports. Second is to how to access and review them. The third will be to develop strategies for improving credit scores. And then the last objective here today is to take steps to monitor and protect credit. Jumping right into credit. So I'm going to say that word a lot today, but we're going to start with reviewing credit. Credit is important because it affects so many aspects of our lives, such as lending, which we will touch on later in this session. As a quick definition of credit, it simply allows for a good or service like tuition to a school, like purchasing a house, etc., to be purchased in lieu of immediate payment. So if you didn't have the I don't know, 50 grand for tuition at a private school somewhere right away, you would be able to kind of borrow from the bank, and you would pay off the balance over time. So, what exactly is good credit? So, it is also known as credit worthiness. And by definition, from a bank's perspective, it is being able to demonstrate the ability to pay, that you have enough money or income to pay back what you borrow, and your willingness to pay, which is basically that you pay your bills on time as agreed. So, some terms here on the screen that we should go over that are common, especially as we're talking about credit confidence. So, the credit bureau, they collect info on your ratings to make it available to those who need that info. So, it is given to those who need some sort of background information related to an application of sorts. So, if you're applying to a job to get insurance, loans, housing, etc., that is the who we would be the credit bureau would be giving this info to. They do not lend money or offer credit themselves. They just do the reporting. So in the US, we have three national credit bureaus that you may have heard of: Equifax, TransUnion, and Experian. They are in charge of those reports. Next term here is credit report. So, credit report that the credit bureaus are in charge of is the historical information collected by those bureaus. So, the info gathered from credit reports helps predict how likely it is you'll be able to repay a loan and make payments when they're due. So, again, your willingness to pay is what shows up on your credit reports. Personal information in your credit report would include like your address, your history of employment, um, bill info, like how you pay, as well as the length of time that your credit has been established. And it will, of course, say how much you owe to your various kind of creditors. Last term here we're going to cover is the credit score. So a credit score is a very important number that's compiled from the info supplied in the credit report. So kind of we're going down here from credit bureau that does the reporting, the actual report, and then the score that's on the report. So credit scores are, they influence your ability to finance major life events. They are kind of like a rating system. So lenders use credit scores when people apply for credit, such as a loan or a credit card. The rating helps people, lenders, to decide whether or not to approve the applications for credit. And it also may be used to help decide the credit terms or the rate that may be approved. So if you have a good credit score, you might get a lower interest rate on your home equity, for an example. What is on your credit report helps to determine your credit score. Although a credit score cannot be fixed, it can be improved over time. And we will talk about kind of that improvement aspect later in the presentation. A credit check, this is something else not on the screen, but another term that we're going to just level set on is so it is performed anytime a consumer applies for credit, such as a credit card or any type of loan. A credit check or credit inquiry is reported to the credit bureaus, um, and they have the potential to lower your credit score by 5 points or less typically. So there are two types of credit checks: a hard inquiry and a soft inquiry. And we're going to go over those differences in the two in just a moment. All right, so next slide here is on who's looking at your credit. It's not just banks and lenders. So there, throughout your life, other events like getting your first apartment or an apartment, turning on the gas or electricity, or getting your cell phone service, purchasing an insurance policy, and even getting a job can require a credit check. So if we're looking here at the screen, things like landlords, employers, insurance companies, those are people who could all be looking at your credit score. An application to borrow will cause a hard inquiry. So, a hard inquiry that will give all of your credit history details and impact your credit score. But even those soft inquiries tell a story about your responsibility with finances, um, or maybe about a lack of credit history. There will be no story at all to get you where you need to be. So, the hard inquiry here require your permission and can impact your credit score by, I think it was 5 points, typically. And then soft inquiry do not require your permission, but also do not impact your credit score. So soft credit checks aren't visible to companies, but the hard ones are. This means, sorry. So a hard credit check, again, this would be like if you're applying for a credit card or a student loan, or a utility company. Soft would be more like a landlord checking it. Okay, I'm going to move to the next one that goes over what is in a credit report. So this is a sample of what is included in a credit report. The kind of bulleted items are what would be on the report. All three bureaus, and that's Equifax, TransUnion, and Experian, they all have a slightly different format, but will include the similar information. It will have a record of where you live, any prior addresses that may be tied to you. It will also include your employment history, bill information, and how long your credit accounts have been open, as well as how much you owe on those accounts. You may also see if you've been sued, that could show up there, as well as if you filed for bankruptcy or changed your name. So you will want to take the time to look at your report and find any discrepancies. If you find anything that does not line up with your records, you should be sure to report it to the bureau. I had a friend of mine who had a pretty common name. I'm not going to say the name. I'm not going to out him on this call, but let's just say it was pretty much as common as John Smith. And one day he checked his credit report and noticed that some accounts did not belong to him. So he had to do some research and disputed these accounts after he realized someone with the same exact name had been mistakenly added to his credit report. The situation was not malicious. It was just a mistake. And this is why you have to check your reports, not just for malicious issues, but as well as kind of regular bureaucratic issues. So, what is a good credit score? So, the 2024 national average score is 716, and the average for those ages from 18 to 25 is 680. It's a little bit lower, just given most likely the length of credit. That is one of the main, is one of the factors that go into it that we'll cover in a moment. So the ranges here that we're seeing, so we got poor, fair, good, very good, and excellent. These help to make sense of how a particular number actually translates. Credit scores are needed for approval of an application, which will vary by lender and the type of credit products for which it is being applied. So, for example, a borrower with a score of 720 applying for a loan secured by collateral, so like a car or a house, may be considered to have excellent credit. And that same borrower if they were to apply for an unsecured loan, like a student loan where there's no collateral behind it, may be considered to have good credit, but poses some risk because it doesn't have that balancing of having the collateral to help support. Each lender may determine what they consider excellent credit based on their type of lending. So while the national average, like I said, is 716, the younger people do have lower, and just because they haven't had the time to build it. So in this next slide, we're going to go over how that factors into a credit score. Okay, so credit score and FICO are used typically interchangeably by a lot of people, but it is important to keep in mind that FICO is simply a brand name. So most lenders do use that brand name that brand name credit score, but others may use a custom score. So just that's a distinction kind of worth knowing. All right, so let's look at these different categories. So our first green box here is payment history, and that accounts for 35% of a FICO score. It's mostly determined by on-time payments. It can also include things by the length of a late payment. So if you were 2 days late on a payment versus 30 days late. One second. Actually, maybe this is a good time to see if there are any questions while I take a sip of my tea.
No problem. Thank you, Emily. Yes, if you have any questions, feel free to drop them in the chat, or you can put them in the Q&A box. If you want to be anonymous, no problem there. But so far, no questions. Back to you. Yep.
All right, thank you. Really had that tickle in my throat there. Um, Payment history, sorry about that. So it can do on-time payments as well as length of the late payment. Um, for example, making one late payment over 30 days can drag a credit score down as much as 90 points, and it would show up on your report for up to 7 years. So it kind of explains on how quickly people can end up with a lower credit score. To put it simply, making at least minimum payments on time is the best way to boost a credit score then, to not have late payments. One way to make minimum payments is by using auto payments. You'd be surprised by the number of people that don't take advantage of that feature, and it would help you kind of maintain a higher credit score. Moving to this next green box, the one in the middle there, 30% is due to your credit utilization. So that's determined by your total debt compared to how much credit you have. So this includes the number of accounts you might have, the amount you on each of them, the percentage of an open credit line in use. So if you use 10% of your $3,000 credit line, that could be incorporated into your score. And then lastly, how much is still owed on installment loans. So those are the main parts that contribute to that. Industry experts advise to keep your balances lower than 30% of the total available credit that you have. So everything in your denominator, you would only want to have like 30% of that used. Um, to say it simpler, for every $1,000 of a credit line or limit, avoid using more than 300. So 30% of that, 1,000. Moving to the gray box, so length of credit determines 15% of the score. How long has an account been open and how long has it been since that account was used? This is why it's important to utilize an account regularly and keeping your oldest account opened to show the length of history in use. All right, so moving to the white gray box here, the 10% credit mix. So your amount of new credit determines 10% of a FICO score. Factors that can play into this are positive credit info on a recovering credit report. In other words, actively using a credit card and making timely payments on an account that was used to make late payments, so kind of showing improvement there. Um, how many and what accounts have been opened in the past 6 to 12 months? And how many credit inquiries have been made recently. Whenever there is a credit inquiry, a hard credit inquiry to your account can bring your credit score down. Thus, applying for too much credit can quickly have a negative impact. So, like if you applied for three credit cards in a short amount of time, then you're going to have those hard inquiries hitting your credit score. Finally, this last kind of white-green section, I'll call it, is 10% of the score is impacted by a mix or variety of credit accounts, such as revolving lines like credit cards, retail store cards, whether it be installment loans like car or student loans, finance companies, like the buy now, pay later type companies, as well as mortgage loans. Overall, creditors want to see a healthy balance with reputable institutions. So now that you know what goes into a credit score, let's talk about how to build it. That will be the next slide. So understanding your rights under the FCRA empowers you to take control of your credit report, correct inaccuracies, and protect your financial future. This is a regulation that follows that, that provides the following protections. So, firstly, access to your credit report. You are entitled to one free credit report every 12 months from each of the three credit bureaus. So, again, Equifax, Experian, and TransUnion. And you can access reports at the annualcreditreport.com. The second right that you have is the right to dispute inaccuracies. So if you find errors on your credit report, you have the right to dispute them with the credit bureau and the company that provided the info. The credit bureau must investigate and correct any incomplete or inaccurate information. You have the right to know when credit is being used against you. So this is the adverse action notice bullet here. So if your report leads to the denial of a loan, credit card, job, or other financial product, the company must provide an adverse action notice. The notice must include the credit bureau that provided the report and instructions on how to obtain a free copy. There are limits on who can access your credit report. Only with those with a legitimate reason, like lenders, landlords, employers, insurers, utility companies, all the ones we covered on the earlier slide, can access your credit reports. Employers must get your permission before checking your credit. It also provides you protection against identity theft and fraud and alerts and credit freezes. So I mean, not against those. It gives you the right to do the fraud alert and the credit freezes. So you have the right to place a fraud alert on your credit report if you suspect identity theft. You can also request a credit freeze. So this blocks your credit report unless you lift the freeze, providing extra security against fraud. The last right that the FCRA gives you is the right to remove negative information over time. So most negative information like late payments, charge-offs must be removed after 7 years. However, bankruptcies typically remain on your report for 10 years. Okay, so there's this concept called credit invisibility, and 26 million Americans are considered credit invisible as they do not have a sufficient credit history to generate a score. So how does this happen? So who would be credit invisible? These would be people who do not use credit, those who prefer cash transactions, they don't have a credit card, they don't have loans, that sort of thing. Um, those who are young, so young adults who just don't have that kind of credit history or accounts set up, they will not have history that would generate a credit score. And the last one is recent immigrants. People who have moved to the country recently, again, won't have a history that will be accessible to the National Credit Bureau agencies. There are challenges that these credit invisible individuals face that are not faced by those who do have a credit score. So they are more likely or will have loan denials. They'll get higher interest rates if they do get a loan because they don't have that history to kind of determine that credit worthiness we talked about. And they just have limited financial options. So it's a good practice to begin establishing credit to avoid these challenges. So I'm going to pause for a question that I have for the participants here in the chat. So what are some ways for someone without credit can start building their score?
No questions so far, though. No questions so far.
Okay.
Thanks.
Um,
Oh, someone said, become an authorized user
yes, that is a good one. We'll talk about that one in a second.
and
That was a
a
good one to
secured
call
credit
out.
card.
Yep. Yep. Getting a credit card is a good one. Secured one. Um, yeah, I think those are good. If there are more that come through, but I'm going to move to the next slide. Those are two very good ones that are right here on my slide. So like we kind of just covered, building credit is critical to your financial well-being. The key is to start early and build slowly. So I'm going to do the two we mentioned first. So I'll go back to the other ones, but duh, um, yeah, I'll just do it as my notes have written. Jumping around will just confuse me more. So one of the first steps you can do is to look at your credit report. So if you want to start building it more, you can see where you stand. So even if you are not actively using or building your credit, you still have a score, and it is important to understand what your score means. You can take the time to fix any discrepancies. Say if you were a John Smith and you had other John Smith stuff on your report, you'd want to fix that. Using a credit card is another option. So you got the option of the secured credit card, which was mentioned in the chat. And the other option is you can pledge a certain amount of, you can pledge a certain amount of savings and the lender will put a hold on that amount allowing the borrower to basically borrow against their own funds. So that's the secured credit card. After the loan is paid off, the savings account or credit card pledged will no longer be on hold, and the applicant will have access to the money. The other way to build credit, another way, is the use of a cosigner. So if you're applying for various lending needs, whether it be a house or a car, you can have a cosigner's credit score to help build on their application to kind of build out that credit worthiness that the lender will then see. Um, at Citizens, we take the higher of two credit scores into account when making decision on rates and approvals if there's a cosigner. On a similar note, for this one, becoming an authorized user, you can look into adding, if say it was your child that you wanted to help build credit, you could look to add them to an existing credit card. So you would check with your credit card company if they report new users to the credit bureau. This would not give the individual free reign with the credit card, but it can help establish early credit. They don't even have to actually use the card. However, if it was your child and you're the parent and you miss a payment as the parent, or your credit goes down, it will affect the student's credit as well. So you can use services like Experian Credit Boost to get credit for those on-time monthly payments for the bills you pay. So that's that last one with the little guy jumping on top of it. Um, and that would, again, allow you to build your credit score. So whichever way makes the most sense for your situation, it all comes back to credit report monitoring. Being aware and watching any discrepancies that can avoid issues and seeing positive movement can be engaging and build confidence to reach financial goals. It's like when they have those thermometers for fundraising and they fill in with the red marker to show the progress. It can help moralize and motivate people. Seeing negative movement, however, can be a real setback. So next slide, we're going to talk about the negative parts. So what can negatively affect your credit score? There are some common factors and occurrences that can potentially decrease your score. Credit score is designed to fluctuate throughout a person's life. It can be affected by many factors. The most common are late or missed payments, and like we touched on previously, as well as collections, account balances being too high, too numerous, or too close to the credit limit. So that's getting to that credit utilization that we said to experts say to target 30%. If you were at like 90%, that would negatively affect your credit score. Length of credit history is another factor affecting your score and, in turn, your approval for a loan. Most lending institutions, for example, require at least 2 years of good credit history in order to approve someone for a loan. All right. Next slide is going to go over the different types of credit available out there. No, it's not. Sorry. This one's going to go over the strategies to repair credit, which is a crucial step towards your financial freedom. By following these practices, you can take control of your credit health and improve your score. Uh, so remember that your credit score is a snapshot of how you are managing credit for a certain period of time, which means that you have the ability to repair credit when needed, and take a new snapshot. Like it's a moving snapshot. So you'll have the opportunity to make it a better picture, so to say. So step one would be to review your credit report and dispute any errors that might be impacting your score. You can obtain the free copies from your report from all three credit bureaus, as we mentioned before, once every 12 months. Step two would be paying your bills on time. Payment history accounts for 35% of your score, as we covered, and setting up automatic payments or reminders can help avoid missed payments. And we talked about the 30-day can be if you're over 30 days late, you can have a 90-point reduction in your score. So avoiding that by setting up automatic payments is a good strategy. The third here is to reduce your credit utilization. Like we talked about, that 30%. So if you had $1,000 loan, don't go higher than don't go higher than 300. and pay down balances on revolving credit to aid in this, in keeping it under 30 or at 30. Negotiate with creditors would be step 4, the people sitting at the table there. So contact your creditors to arrange payment plans or request goodwill deletion for missed payments. It's always worth asking. So, step 5 here would be to limit new credit applications. Too many new inquiries can negatively impact your score. We talked about the inquiries doing that. So, only apply for credit when necessary. 6, consider a secured credit card. We talked about this one and it was mentioned in the chat for using it to rebuild credit responsibly by making small purchases and paying off the balance in full each month. How to use credit. So, there are certain uses for credit in the short and long term. So we've got kind of the green here is the long term, the gray is the short term. Things like buying a house or financing your education and buying a car are products designed to help you finance these over a length of time. Student loans and mortgages um, will help you do that with set repayment terms that set you up for success in the long term. So typically, mortgage 30-year loan and you have your payments throughout that time. If you're financing something short term, that's when you would want to consider other things like a credit card or a personal loan. So credit card, people often use, day-to-day purchases, that sort of thing. All right, so to go through some common loan terms. So uh, most people in their lifetime will take out a loan. So there are some things in this world that need to be purchased, and we often don't have the cash available to pay in full upfront. Whether it's a mortgage, car loan, student loan, it's best to get familiar with some common terms in the lending world to help you make smart borrowing decisions. When you're looking at loans, presented with different interest rates and term options. And knowing the definitions and differences here are help you be prepared for what to expect when you have to borrow money. So interest rate. Interest rates are the rate at which your interest accumulates on your loan. So this is it's the way the banks make money off of lending things. So they're going to give you the money to go out there and buy the purchase that you need, and then you're paying them back throughout. But in order for kind of the bank to have a vested interest, they charge an interest rate. So interest is the cost of borrowing money, to say it kind of simply. Um, and there are different types of interest rates. So the first would be a simple interest rate, which is calculated on the principal or the original amount of the loan. So um, that's the first type of interest. The second is compound interest. This is calculated based on the principal amount and the accumulated interest of previous periods. So you can kind of regard it as interest on interest. So compound interest on interest, simple just on the principal. Those are the two types. Loan term is essentially the specific length of time that your lender or your bank is giving you in order to pay back your loan. The most common term lengths are 5, 10, or 15. When choosing a loan term, you should choose the option that works best for you. In most situations, you should choose the shortest loan term possible in order to get out of debt sooner. When choosing a loan term, however, make sure the payment is something you can comfortably afford every month. If you do not need to extend your loan term for a lower monthly payment, that's fine. You can always refinance if you find you have more money to spare down the road. There are some fees that apply when borrowing money in the form of a loan. So these fees are known as application origination or disbursement fees. Um, yeah, so those are, sorry. There we go. Sorry, did not mean to flip forward. So those are kind of the fees that go along, and they're one time, and but that's again going to be part of your loan terms. All right, actually move to the next slide now. When we talk about credit mix, there are two basic categories of consumer credit. So there's the revolving credit and installment credit. Revolving credit can be used repeatedly for purchases that will be paid back monthly. though paying the full amount due every month is not required. The most common form of revolving credit are credit cards. However, there are some other ones listed here on the screen. For example, personal lines of credit, home equity line of credit, a HELOC, or an overdraft line of credit. Installment credit is used to finance a specific purpose for a specific period of time. So you see them here on the screen: student loan, refinance, education loan, car loan, mortgage, personal loan. Consumers are required to, for the installment loans, pay a regular payment schedule, usually monthly, that includes interest charges until the principal is paid off. Some common examples are I just said that they're on the screen. The interest for installment loans varies by lender and is tied closely to the consumer's credit score. So moving to the next slide, we're going to talk about how to keep your information secure. Um, we got two things here on the screen. We've got account fraud and identity theft. So we're going to go over some defining characteristics of both that would kind of, when you're reviewing your credit score, you should be checking for kind of these things for safety and should make sure that you're covering off on the risks here. So when checking your reports for errors, be sure you recognize all of the things listed. Um, Unfortunately, fraud and identity theft have become more and more common. Careless disposal of personal information, falling victim to scams, and using insecure internet sites are major contributors to the increase. Identity thieves use your information to open new credit accounts in your name. Then, when they don't pay the bills, the delinquent account is reported on your credit report. Avoiding identity theft is a lot easier than trying to repair the damage. So, it's kind of a preventative. Actions you can take are simpler than fixing it after the fact. Victims of identity theft are responsible for proving the accounts open do not belong to them. This process can take years to clean up. So, protecting your personal information by being extremely cautious with whom you share your info with is a great idea. Fraud is a different thing. This is when someone uses a legitimate account belonging to you without your knowledge. So if this happens, you will need to dispute the fraudulent charges with the lender. Um, TransUnion and Equifax have their own processes for disputing credit reports, but Experian provides 3 methods for submitting disputes: online, by phone, and by mail. Once the dispute process is completed, any changes to your credit reports could lead to changes in your credit scores. Despite all of this, most credit cards come with a fraud protection. You should probably make sure yours do. Terms and conditions will apply. The best way to stay aware that your accounts are still safe is to check your credit card statements every month. And most people don't do that, and you should. Then you can kind of see if a fraudulent charge has been posted to your account. So prevent it by keeping your credit card safe and secure. Okay, so there are some common ways that identity thieves can commit their crime of identity theft. And I know it's easy to think that this will never happen to you, but the reality is a blank slate of no credit is just as sought after as established credit. So it can happen to you. One way is to secretly divert mail to a criminal's address to gather personal and financial data of a targeted person. An example of this would be the thief changing their address or your address to theirs. They may also dig through garbage cans or public dumpsters in search of canceled checks, credit card, or bank statements, as well as pre approved credit card offers. Thieves can use this info to open up new accounts in your name. Another common way is just straight up theft. So deliberately stealing mail, computer, phone, purse, or wallet to get access to your personal information, or stealing key documents such as your driver's license, your social security card, or birth certificate. Someone can also commit fraud by just secretly watching over someone's shoulder to see what password or other personal information a person uses while they are online or talking on the phone in public. Think of how many times you might have just ordered pizza and shared your credit card info out loud. You don't know who's around listening. So you may want to be careful to do that in private or around people that you trust. Thieves can also use rogue and public hotspots to intercept data and upload malware. Another way to ensure safety is to never respond to social media chain requests for mail. You never know what those random chains that ask for a photo and the name of your first pet or car or favorite album or high school, etc. Um, they can use those answers to become you. On the same page, you should always want to ensure your devices, like your phones and laptops, are up to date. Software updates in order to avoid thieves trying to steal your information through security holes in your systems. So when you get those kind of push notifications, update your phone now, it's usually a good idea to do it from a security hole perspective. The last one on the screen here is the phishing or the smishing, which is the text message phishing. So that is when you get an email or text that looks legitimate and redirects you to a fake website that will ask for personal information. All right, on the next slide, I'm going to go over an example of phishing. So how can you spot and avoid phishing scams? So before you click on a link or share any of your sensitive information, say you got an email that said you have a new reward to claim, or you get a text that say you've won a gift card from Walmart, and you have to click on this link. Um, you should check it out. If you have concerns about an email, look up the sender's email address, phone number, or website yourself by simply using Google or whatever web browser is your choice. Most importantly, don't click on any link that leads you to another site or asks you to log in. You could be giving your username, password, or other personal information to scammers while possibly downloading malware onto your device. Take a closer look when you do get these messages. While some phishing emails look completely legit, bad grammar and spelling can be a tip off to phishing. So if we look here at the text here, TP claim, so not to claim. So that's a clue there. And the other thing is looking at the actual. It's kind of hard to see here, but if you look at the email address and if it doesn't match one you've seen received stuff before, it's most likely a scam. The other thing that they often do is instead of like Target, maybe it's like Turget and they forget the A or something, they'll drop a letter and it looks like the regular email address, but they just switched one letter. Last thing is if they use the wrong, so similarly, if they use the wrong department name, so for example, if a student loan, if you were there trying to impersonate the financial aid department, they might also call themselves like financial department or something like that, where they switch the name. And that would be another clue that it's probably not a real email. All right. So going to the next slide, we're going to cover how to guard yourself against identity theft. Um, As we mentioned throughout today's session, you should always be sure to monitor your credit report. It's a free and easy way to stay on top of your credit score. One way to guard your physical information is to invest in a shredder. So, you know, for the dumpster diving that we talked about just a moment ago, it makes it a lot harder. Or you can also shred your things like credit card offers and bank statements just so you eliminate that risk. Additionally, you should keep in mind what you have in your wallet in case your wallet's ever stolen. Of course, carrying around your license and credit cards makes sense, but consider leaving that social security card or passport at home unless you need it to limit the info that someone could obtain if they were to pickpocket your purse or something like that. Um, Along those same lines, always keep duplicate copies of your important documentations in the case that something could happen. It's always better to be safe, so you should also can consider a credit lock or credit freeze. Okay, so
I do have a quick question here.
yeah,
Someone asked, what happens if you click on the website given?
click on the website in the phishing example, I'm assuming.
Yes.
Um, Different things. So often it would My understanding is that it would then either download malware to your computer or your phone, um, and then that can people bad actors would then be able to see what you type. So they are things that can allow you to see which someone's typing remotely. So if you were then to log into your bank app later in that day, they might be able to see your name and your password. And then they would have that info and could take your money. The other kind of thing would be if you try and log in, just like you click on it and it takes you to a site and it says, log in with your email and password here, then it would directly have it. And it would be like a fake website. So instead of it being walmart.com, it would be walmart.com. And then they'd have your info. And if you had your credit card linked to your Walmart account, then they would have that info going forward. Okay, so getting started and kind of your empowering with your credit awareness, you're building your credit confidence is as easy as going to annualcreditreport.com and requesting free copies from the three major agencies, which are here on the screen. And I've said them a bunch, but they're Equifax, Experian, and TransUnion. Why would you do all three? Because each one has different info based on where the creditor reports transactions. So your bank might report them to Experian, and they're each want their own proprietary score info, so they're somewhat different sometimes. So that's why it's worth getting all three. The other thing is you probably have heard of apps like Credit Karma, which can be a fun place to look at your score and kind of see how it's doing. The best advice is to do the yearly check directly with the credit bureaus because that is where they do their yearly check. So just to make sure there's no surprises, you should going directly to the credit bureaus. It's important to manage your credit and carefully review your credit report as credit scores influence the ability to finance major life events such as paying for college or weddings, and buying a home or a car. A couple of final major points here that I'll cover. Under federal law, once every 12 months, just to like bring this home, you're entitled to get a free copy of your credit report. Again, creditreport.com, and this would get it from Experian, Equifax, and TransUnion. Highlighting this very strongly because there are free sites that might be advertised out there that they are then likely to try and sell you a subscription-based service that you might not want or even need, and sometimes they're far from free. So it's better to just go directly to them. And um, a good way to take advantage of the free annual credit report law, it would be every 4 months to order a free report from a different agency. That way, throughout the year, you're kind of getting a different perspective on what the lenders are reporting about your credit history. So maybe you plan it out. So in January, you do Equifax, in May, you do Experian, and then I think I might have messed up my months, but then September, you do TransUnion. So something like that, where you're checking them throughout the year. And if you've never checked them before, it's best to obtain all three the first year to get a clear snapshot um, on your credit history. Because they can make a difference in critical life events, check reports before applying to a new job, mortgage, or other big loan. That way, you can take action before that key decision is made. If you are denied a loan, you have the right to request a free credit report as well. But of course, it's too late at that point. And lastly, we talked about this a bunch, but check your reports for errors. Dispute any errors with the credit reporting agency as well as the lender. Some errors are easy to fix, others are more serious than just more serious. So most important thing that you can do is to just get the conversation started. Don't be afraid of debt, but learn to understand it and prepare for good debt and investments in your future. All right. That's all I've got for today. So I'm just going to go to this next slide here that just has some info here and some resources that I think will be sent out. The deck will be sent out. I think Jennifer mentioned that. So these will be kind of included there. And then my last slide is a feedback thing, but yeah. I'm going to stop. And if there are any final questions, I'm happy to answer them.
Yes, we do have one here. Does your credit score go down when you check it more than once a year?
It depends on how you check it. If you're requesting the free report, it should not. So as long as I mean, if it's the one time you're going to Equifax for the year, it shouldn't. But if you're going to Equifax twice in 1 year, it would probably impact it. So it's kind of that's why there's the three. So you might want to check Equifax now in October, and then you could check another one in a few months. If you wanted a more kind of frequent checking, you should switch between the credit bureaus.
Nice. Okay. Are the credit scores that sometimes like connected to your bank account, how accurate or valid are those?
That's a good question. It kind of depends on if you're going through your bank and they're giving you their view. So that's a good way to be like, okay, well, that's what my bank sees. That's what my bank is treating me. So like it's a good pulse on it, I'd say, because they want to make sure you maintain your credit worthiness. So how they're looking at um, your FICO score, your credit score is important to you because that's who lent you your money. If you were going to apply for something new, however, you would probably want to get a credit report directly from the bureaus so that you have their view. So I know often and at Citizens, we use sometimes a mix. So sometimes we'll have a custom score as well as a FICO score, just because there are certain aspects of someone's credit worthiness that we might want to pay more attention to than others. So when we talked about, I think it was student loans, and we said um, someone with a 720 and no collateral might not be the best. That might not be in our risk appetite at that time for like a no collateral loan or what was 620 no collateral loan. However, if you were then having a house as your collateral, it just varies based on product. So I would say you can use the one that your bank, your credit card shows you as kind of like a good way to see what they're thinking of your credit worthiness, but it is definitely worth also getting the direct ones from the credit bureaus.
Okay, beautiful. That is the questions I have for now, but I will go ahead and close us out. You can always email me if any more questions come up and I can get that answered for you. Let me know, Emily, do you mind if I share there?
No, that's totally fine.
Okay, I will share my screen. Is it okay if we close this one out?
Oh, I'm sorry. I'm still sharing. Oh, I thought I stopped. I'm so sorry.
It's okay. Yes, real quick. So next week we have the debt reduction blueprint seminar. So, your guide to understanding debt and most importantly, understanding debt strategies to get out of debt, or what's good debt versus bad debt, and understanding how that makes a huge difference in your wealth building journey. So you can click on the link in the chat or scan the QR code. We still have free financial coaching. You have 1 free hour with our coach here, Samantha Morales, who, if you have been coming back, you may have seen presenting in other webinars. You can come to her and talk to her about ways to increase your credit score or different credit score strategies that you can use for yourself personalized. And this is 1 hour, no commitment at all. You don't have to come back, and there's no hidden fees or charges, just for you to really get your questions answered in private. And lastly, we have Enrich, which is an online platform where you create an account, take your financial wellness quiz just to kind of understand where you're personally at. And then it provides a wealth of resources from mini courses to articles, blog posts, webinars from their own personal platform, and so much more. It's an incredible resource, easy to use, so I highly recommend it to anyone who wants to continue on their journey. And that is it from us today. Thank you for joining us, and we will catch you next week. Thank you, Emily.
Thank
Bye.
you. Have a good afternoon, everyone. Bye.